Meta generated $31.9 billion in cash from its operations this quarter. That's up 25% from a year ago. Honestly, that's a fantastic number. But here is the weird part. Meta kept just $784 million of it. And no, that's not a typo. This is not a story about Meta having a bad advertising quarter. Actually, the advertising business had a pretty good quarter. The interesting story is what happened to all that cash after Meta generated it. I am Vikas, your host. This is what changed from VYNG. We don't chase headlines. We explain what actually changed. Let's start with the headline number. So, Meta reported earnings of $6.18 per share, which is down 13% from a year ago. And it looked like a big miss because analysts were expecting around $7.23 per share earnings. So at first glance, pretty ugly. But there is a problem with that comparison. Meta itself disclosed about $2.4 billion in legal related charges and another $1.18 billion in severance costs. That's roughly $3.5 billion of unusual costs sitting inside this quarter. Take those out, adjust for tax, and earning come to roughly $7.35 per share. The street was looking for $7.23. So Meta actually beat. That means the earning miss you are seeing in the headline is not really the story. The real story is somewhere else. And almost nobody is going to find it in the headlines and the EPS numbers. You have to look at the cash flow statement. So, what actually changed? Let's go through this in three layers. And each layer gets a little more interesting. Layer number one, the headline. And the headline says $6.18 in earnings per share. That is down 13% and below expectations. Sounds bad, but there is an important detail here. Meta reports its earning using strict accounting rules. Analysts, on the other hand, usually forecast an adjusted number. So we are basically comparing two different measuring sticks that make the headline look worse than the underlying business actually was. Now, let's fix that. Layer 2, the underlying business. So, Meta told us exactly what was sitting inside the quarter. About $2.4 billion related to legal proceedings and another $1.18 billion related to severance after the company cut jobs in May. Together, that's around $3.5 billion. And take those costs out, adjust for the tax impact, and you get roughly $7.35 per share against expectations of $7.23. So, on a more apples to apples basis, Meta had a good quarter. Revenue was $60.8 billion. That is up 28% from a year ago. And it came in above the midpoint of the revenue range that management gave investors back in April. Even better, price per ad increased 12%. That's important because Meta is getting more money from each ad it sells. So far, so good. But now we get to layer 3, and this is where things get really interesting. Free cash flow. Meta generated just $784 million of free cash flow. A year ago, about $8.5 billion. That is roughly a 91% collapse. Think about it. Revenue grew 28%. Operating cash generated grew 25%. But free cash flow almost disappeared. Why? Because Meta is spending an insane amount of money building out its AI infrastructure. Operating cash flow was $31.9 billion. Capital spending was $31.1 billion. So basically, $31.9 billion came in. $31.1 billion went straight back out the door to build the business. And what was left? That is $784 million. Here is the easiest way I think about it. Imagine a family gets a 28% raise. That's a huge raise. You would probably feel pretty good about that. But but then in the same year, they stop putting money into savings and take out a massive new mortgage to build a much bigger house. Nothing went wrong with their income. Their income is actually fantastic. The problem is that the house suddenly became a lot more expensive. That's basically meta right now. The income is great, the spending ambition is just getting enormous, and here is where the mortgage analogy becomes very real. Meta raised $24.9 billion of new debt during the quarter. Long term debt went from about $58.7 billion to roughly $83.7 billion. And something else happened. Meta has now bought back zero shares for 3 consecutive quarters. That's after buying back around $26 billion of stock last year. So the savings stopped, the borrowing increased. And for the first time in this AI build out, Meta's advertising machine is not completely paying for the ambition by itself. So, why does this matter? I think there are three big things to take away. The number one, operating leverage is moving in the wrong direction. Meta's operating income fell about 8% year over year. That's the first year over year decline in 13 quarters. Now, you might say, okay, but what about those one time charges? Fair question. Take them out. Even then, operating income grew only around 9%. Revenue grew 28%. That gap matters a lot. Revenue is growing much faster than profit. And the biggest reason is spending. Research and development is now about 35.5% of revenue. A year ago, it was around 27%. Here is another way to look at it. Meta added about $4.5 billion of revenue compared with the previous quarter. But R&D spending increased by almost $4 billion. So roughly 88 cents of every additional dollar of revenue went into R&D. That is a huge number. And it tells you where management's priorities are. AI, AI, and more AI. Number two, what is the reality labs doing? And that is not actually the biggest problem right now. So this one surprised me. So for years, everyone has looked at reality labs and said that's where Meta is burning money. And yeah, reality labs has lost tens of billions of dollars. But this quarter, something interesting happened. Reality labs actually behaved pretty much the way management said it would. Its first half loss was about $8.65 billion. Last year, it was about $8.74 billion. So the loss actually narrowed slightly. Revenue also increased around 16.5%. In other words, Reality Lab is roughly following the path management laid out. The bigger issue is somewhere else. It's the core business: Facebook, Instagram, WhatsApp. The machine that actually makes the money. The family of apps segment saw its operating margin fall from about 53% to below 39%. Revenue increased 28%, but operating income fell about 6%. And even if you give the business credit for all the unusual charges, the margin is still down more than 8% points. That's the part I'm watching. The division everyone loves to criticize is actually following the plan. The pressure is showing up inside the crown jewel. So the AI story needs a little more nuance. Meta's management opened its report by saying AI is accelerating the core business. And honestly, there's evidence for that. Price per ad increased 12%. That suggests Meta's targeting and recommendation systems are getting better at monetizing users. But there's another side to the story. Ad impressions, basically the number of ads Meta shows, it is grew 14%. That is down from 19% growth previously. And daily active people grew just 3%. That's also slowing. So the AI story is showing up mostly in price, not in the number of people, and not in the number of ads. That distinction matters because there are two ways you can grow revenue. You can sell more or you can charge more. Right now, Meta is getting more growth from the second one, and price is generally harder to keep increasing forever. So, this is Wing's first published report on Meta. So, we did not have an earlier score to compare it with. Instead, we created a baseline using Meta's previous quarter, and that previous quarter had four things going for it: a roughly 41% operating margin, about $12.4 billion of free cash flow, accelerating ad impressions, and no new debt. That baseline gives us a 6.5 out of 10. But this quarter broke all four of those conditions. So our score moves down to 5.4 out of 10. And just to be clear, again, this is not a buy or sell recommendation. It is simply our assessment of how much confidence the current evidence deserves. So, what happens from here? There are three things we will be watching very closely. The number one, does free cash flow stabilizes? Management's guidance suggests capital spending could be somewhere between $39 billion and $47 billion per quarter for the rest of the year. That compares with roughly $32 billion of operating cash flow this quarter. Do the math. If spending stays that high, Meta could actually report negative free cash flow next quarter. That would be a major development. Second, does the buyback stays at zero? Meta has now gone 3 quarters without buying back stock. If that becomes a fourth quarter, then this starts looking less like a temporary pause. It starts looking like a policy. And that matters because buybacks reduce the number of shares outstanding. If buybacks disappear while the share count starts rising, that changes the per share math for investors. Number three, do ad impressions stabilizes? Right now, ad impressions are growing around 14%. I want to see whether that stabilizes because if ad volume keeps slowing while revenue growth increasingly depends on higher prices, then Meta is relying more and more on pricing power. And that's something we need to watch carefully. So, here is the real story of Meta's quarter. It was not really an earning miss. Once you adjust the unusual charges, the underlying earnings actually beat expectations. The advertising business is still strong. Revenue grew 28%. Price per ad increased 12%. There is a plenty here to like. But that's not what changed. What changed is the cash. Meta generated $31.9 billion from operations and ended up with only $784 million of free cash flow because almost all of that cash went straight into the AI built out. And then Meta borrowed another $24.9 billion. That's the part I think investors should pay attention to. This is the quarter where Meta's advertising engine stopped being able to fully fund its ambitions on its own. And Meta started reaching for the balance sheet to fund the difference. That doesn't automatically make Meta a bad investment, but does change the risk. And that's exactly what we are here to track. If you want to see every source calculation behind this analysis, you can find the full research report at VYNG.io. The link is also in description. Everything is sourced directly from Meta's filings because trust is not built by sounding confident, it's built by showing your work. I'm Vikas. This has been what changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.